Hey, thanks for joining today. This is a Halo webinar. We're talking about Silicon Valley Bank and beyond. Today, I'm joined by President and co-founder of Halo, Jason Barsema, and Dr. Neal Soss, former Global Chief Economist for Credit Suisse and beyond. He's spent some time at the Federal Reserve, so we think it's a great opportunity. Everybody's talking about, obviously, on Wall Street this week and throughout the financial community, what's going on with banks and beyond. So we thought we'd pull this webinar quickly together. Let's just kick it off with Dr. Soss. Dr. Soss, obviously a ton of talk this week about the banks, Silicon Valley Bank signature, some the so-called regional banks and the failures. You have a pedigree, having worked at the Federal Reserve and as the highest institutions on Wall Street. Help us separate the noise from the signal. What is your take on what's happening currently with the banks?
Yeah, if you've been around as long as I have, for your sins, or for my sins, you've seen a lot of financial crises. And it's, while you're sort of in the early stages of something, it's always obviously hard to know how things exactly will play out. So we'll talk in a minute about sort of what change has come upon us in the last week and which sectors of the economy might notice that. But for starters, let's think about where we were 10 days ago. 10 days ago, the economy was on a roll. You had particularly strong performance in the labor market. Inflation was moderating, but nonetheless still at an unacceptably high pace. And the Fed was prepared to fight that inflation, to use sort of a crude image, tooth and nail. So you even had a sort of a threat of resuming 50 basis point moves in the Fed funds rate after subsiding a bit earlier in the year. What would have slowed in consequence of that is basically housing. The mortgage rate having gone up, you would have had less housing activity. You might have had a little less in the auto sector, which also is interest sensitive. Commercial real estate, particularly in sort of office space in central cities and so forth, was obviously under strain, not necessarily because of interest rates, but because of the pandemic and its effects on work habits. But with that in mind, those were the sectors that were likely to slow down anyway. Then along comes a circumstance that was in some ways predictable, but the manifestation of it certainly was not. And that is when interest rates were low for a period of time and then move up relatively rapidly, you find a lot of assets on financial sector balance sheets, whether banks or insurance companies or other financial intermediaries, that from a mark-to-market point of view are underwater. Meanwhile, by and large, their liabilities are not underwater. Their liabilities are still at par. The assets from a mark-to-market perspective are worth less than they were before. That makes it very hard to restructure the balance sheet to take advantage of the new higher interest rates, because if you sell something from the past, you don't get 100 cents on the dollar to reinvest at the new, more attractive interest rates. Exactly. So that was always going to be there as part of this transition from an environment of extraordinarily low interest rates to interest rates that, in my view, are not extraordinarily high. They're just a lot higher than they were before.
Well, you also spent time with Volcker in the early 80s, so that everything is subjective and relative, I guess.
Well, exactly. And, in the aftermath of the shock to interest rates in the late 70s and early 80s, basically you wound up losing the whole savings and loan industry because their deposits were the deposits at par from the past. The mortgages that they had were the mortgages from the past at interest rates that were still too low. And the effect of that was that some of them took too much risk, others simply bled slowly. But in any event, the industry, in effect, disappears a little too strong a word, but certainly was very substantially curtailed. So that's what happens. So now what's going to happen in the aftermath of this? Well, two things. First, interest rates have come down. Well, they haven't come down to where they were before, but they've come down a lot. The effect of that is, for example, that the mortgage market is likely to open up a little bit, and housing's likely to revive a little bit, and car sales are likely to revive a little bit. That's all the good news. Bad news on the other side of it is that, by and large, I would expect that banks, being now particularly more scrutinized, more closely scrutinized for their positions, are going to be tighter in extending credit. And a sector like commercial real estate, which is already under some strain, is presumably going to be that much less easy to finance, or to put it more bluntly, more strained. Is the economy going to slow down in consequence of that? Probably some. The pickup in housing and autos is probably not going to offset everything else, the tighter lending standards in particular. But I don't think it's going to be catastrophic if the financial damage stops here. And that's the problem that the Fed's got as they approach next week. What are they supposed to do? Are they supposed to stand pat and wait and see how much the financial problems either accelerate or diminish? Or are they supposed to go, let's say, 25 basis points to illustrate that the financial problems are not that overwhelming and inflation remains a central concern? I don't think 50 basis points any longer is within the framework of what they can do. So it comes down to, do they do a little or do they do nothing?
Well, I have a poll I'm
very
going to
hard to
launch for our viewers about Fed's move next week. Not to interrupt you there, Dr. Soss.
No, that's perfect.
What do you think? We'll see what happens here. What's your take? I know some people are the popular is, what should the Fed do and what will the Fed do? We'll let you have either or both. What say you, sir?
I think both. I mean,
Well, if I were a betting man, I would wish that they could move 1/8% the way they used to once upon a time. Because
no law that you can.
I'd take a 50% chance of a quarter and a 50% chance of no change, which is not a particularly, what shall I say, decisive forecast. I've been in the forecasting business, and I know that's not the most helpful forecast you guys have ever heard. But it is suggestive of the nature of the environment. And if they do either one of those, my guess is the markets don't do much. But my guess, for what it's worth, is I would tilt a tiny bit towards the 25 basis point move to signal that, from their point of view, financial stability is not that much imperiled under these circumstances.
And I was
And of course, who knows what the next day or three will bring, particularly with the rating agencies out there doing God knows what, and market participants doing what they want to do, particularly the fast money that's trying to find a place to short or a place to buy something cheap. But barring a further financial ruction, I would tilt just the tiniest bit towards a quarter point. Let's see what the panelists or what the rest of our audience thought.
Overwhelmingly,
Yeah,
25 basis points raise is the
excellent.
Well, the risk that you run if you don't, at the end of the day, is that things are worse than they are, right? And so if you stay pat with inflation at 6%, it could signal to the market that the financial problems that we're dealing with SVB and First Republic and some others are actually systemic and worse than they are. Not to mention that you've got a little bit of a pairs trade going on. And I'd love to hear your perspective, Dr. Soss, of the ECB raising 50 basis points this morning. They were obviously in the same exact position that the Fed is in next week. How does that play into the Fed's decision of ECB's out front? They raise, 50 basis points. Does that impact what Jay Powell or inflation in the United States? Would love to hear your perspective.
Well, it depends on how markets in Europe and around the world absorb that 50 basis points. If markets go off a cliff, then obviously that tilts the Fed. If markets don't, that tilts the Fed as well. For what it's worth, I think it's fair to conclude that the ECB didn't face quite the same choice as the Fed, because they are really much earlier on in any process of reducing the kind of stimulus that they've been providing. and their inflation is also just unacceptably high, in some ways more unacceptable to them than ours is to us. So so far, I think the markets have taken that 50 basis point move okay.
Mhm.
And I think what the authorities have to do here is a kind of no mas signal. No financial institution is going to get into any meaningful trouble in the next 10 days, 30 days, 90 days. They will simply put a floor under everything if they can. And of course, that's ultimately very much dependent on whether markets overwhelm the authorities. Typically, markets don't like to overwhelm the authorities. And so on the whole, I'd be a tad more optimistic rather than less.
So what is, in your opinion, a bigger risk? Is it inflation right now or banking instability? Not banking instability is obviously systematic, but the inflation is also important too. Which of these, would be, in your opinion, should investors be more concerned about?
Well, it goes to the question of which of those is more acute, which of those is more extreme. Inflation at 6% is not acceptable. Everybody agrees to that, I think. But then again, it hasn't deteriorated lately. If anything, you could sort of tease the data to say it's on a mildly, modestly improving path. And there's no particular reason to think it's going to shoot off in the wrong direction imminently. So you can afford, in a way, to say, okay, it's still really our first priority, but it's not the acute priority, whereas financial stability at the moment has a more acute aspect to it. Over a longer horizon, it's hard for me to imagine how you can get financial stability without price stability. And frankly, it's hard for me to imagine how you get price stability without the financial system being functional. So you got to get both of those under control.
Yeah, great point. Let's bring in Jason here. Jason, 2 weeks ago to the day, Halo wins an award for Fast Company's 10 most innovative companies in the world. Seems like a lifetime ago at this point.
It does.
So we didn't get to rest on our laurels too much there. It's interesting. I'm sure you guys have been doing a fair amount of reminiscing about the stories, how this time is similar to the last time. And of course, Dr. Soss, you got a few years on Jason and I. You've seen a few more of these.
I don't believe it for a second.
So I got enough gray hair that even I have seen them as well. What's interesting about this one is compared to others is throughout calls all week, I'm hearing about we have to be empathetic and compassionate and just a warmer tone. I don't know if it's a cultural thing, society as a large, or is it a Halo cultural thing, but I've never before in any of these other instances heard compassion being something we needed to be important about. What's interesting, and I won't go into any specific details, is clients this week have overwhelmingly said it's just, look, the technology is great. We love that you win the awards, but when the shit hits the fan, as it did this week, it's the white glove service that sets you apart. All of the sexy technology is important, but it's the customer service. Again, when the proverbial shit hits the fan or the tide goes out, whatever your favorite metaphor is. Jason, what are we saying to clients right now? I know you're burning up the phones, and as soon as we're done here, I'm certain you're back on a client call. What are you talking to clients about right now?
I was barely on time for this call, candidly, as I was wrapping up another one. And, at the end of the day, Dr. Soss and I grew up at the same firm, and at Credit Suisse, we were always taught to, call your clients 3 times more in a bear market than you would in a bull market. And, right now, people are naturally concerned. I, answer your question about empathy. Of course, it's the Halo culture. As you can see, the sign over my right shoulder of impact before profit. We wrote our value proposition or our value statement before we even wrote our business plan. That is the foundation of our morals and our values and our ethics at Halo. We have built Halo and created Halo for a bigger purpose beyond just selling structured notes. It was really about democratizing investing. And even more importantly, it was about providing a more sufficient and efficient savings product to be able to navigate turbulent times that we're dealing with right now. And that's the power of what structured notes and protective investing products can do, is that they provide comfort during advisor conversations to say, you know what, things are going a little haywire right now, right? But at the end of the day, this is why we have protection in the portfolio. And they also give clients the comfort to say, if this is a buying opportunity, and I personally believe that, we are nearing the bottom here, and over the next few months, it's going to be a great buying opportunity within the markets. It gives clients, not just advisors, but clients, you're having the conversation with the end client. I'm an end client of someone, right? I want to be comforted to know that if I get into the markets, I'm not going to lose another 20% like I did last year. I want that comfort of the cushion to say, if we're early, it's okay because we have the protection on the downside. And if we're right, we can get the enhanced upside that a structured note can offer. Getting back to the cultural part of empathy, though, and your question, David, is I think this time it's different than 2008 and 2009. Number one, this is not a systemic problem or a solvency or liquidity problem at the major banks. The major banks, the too big to fail banks are receiving record inflows. I saw a report yesterday that BAML received $15 billion in the last 3 days of inflows. So this is not a systemic issue that we were dealing with in 2008 and 2009. What it is, it's a crisis of confidence in the regional banks, and the regional banks are the backbone of this country, really the foundation of this country that provide lending and financing to not only small and medium-term enterprises, which is a very critical part of the financial infrastructure in this country, but personally, it's important to us because those are the banks who are lending to startups. And so I think you're hearing the empathy about Silicon Valley Bank to say, well, they helped fund Silicon Valley and a lot of the great companies that we know and we use today. We may not be having this conversation today without Silicon Valley Bank because they also helped fund my father's companies back in the 90s. Luckily, Halo has zero exposure across the board to Silicon Valley Bank, and all of our cash is with the too big to fail banks and the major banks. So we're very fortunate with regards to that. But people are losing their jobs. You're losing a bank that helped create the innovational backbone of this country. And so I do think it's important to be empathetic. And more important, clients are scared. And as an advisor, you have two jobs. Job number one is to try to make your client, money and reduce risk in the portfolio and meet portfolio objectives. Objective number two is to be a psychologist. I've cut my teeth during the financial crisis and every other crisis that's happened, as Dr. Soss was alluding to. And I think the most important job of a financial advisor right now is to be calm, right? State the facts. We all know what the facts are about the financial system in the United States. We all know what the facts are about the state of the financial system within Europe. We know what the facts are about the stability and the capital position of Credit Suisse, which has been a very important topic over the last 48 hours. State the facts, but regardless of the facts, you always have to be able to take the approach of what is best for your customer, not just in terms of taking advantage or making money in types of markets like these, but what makes them sleep well at night because it's their money and we all worked really hard for our dollar. And I think that ultimately is why not only the world is taking an empathetic approach, but Halo takes an empathetic approach with our clients. We're not trying to shove product down anyone's throats. We're just trying to pump the brakes a little bit right now to say it's going to be okay. And when someone loses money, there's also an opportunity to make money and take advantage in these markets.
Yeah, well, it's funny you mentioned. I've heard all week on CNBC. Is that the words of Halo about some folks are going to make some money in this instance, and others are going to lose. And interestingly, you had mentioned we may not be here. You had mentioned that, and you kind of could say maybe because of the great financial crisis, maybe we wouldn't have been here either, Jason. Because correct me if I'm wrong, but in your days at Credit Suisse, that the structured notes was a backbone during that crisis that you were using when managing money, that just helped set up today, that gave you the conviction to make this a wholesale business, to strike out, entrepreneurially and make this what it is today.
That's exactly right. And what I always talk about in regards to structured notes, as many of you know, I was a partner on a large private banking team there, and structured notes were a very important part of my asset allocations. About 20% of my allocations on average were dedicated to the product. 25% of my personal portfolio on average is dedicated to the product. Has been that way for over 15 years. And how I started using structured notes was exactly, like a time that we're dealing with right now in regards to, we were in the, kind of the back stages of the financial crisis, early 2009, when I started to fall in love with the product because I thought it was a good buying opportunity. But calling my client like a Dr. Soss and say, hey, Dr. Soss, the markets are down 50, 60%. I think it's a good buying opportunity. Sorry, you lost 60% of your portfolio. but I want to put fresh cash into the market right now and I want to potentially lose you more. That's not a very good conversation to have, even if it's the right one, right? And it was the right one. And that's why I thought structured notes were so elegant, inefficient in practice, which our technology solves a lot of those inefficiencies, but elegant, because I could call Dr. Soss and I could say, Dr. Soss, I think it's a great buying opportunity. I don't know if it's today. I don't know if it's 3 months from now. I don't know if it's a year from now, but I do know that in 2, 3, 4 years, that the market will be higher than it is today. And back then, if it wasn't, God help us all, right? Our dollars are now wallpaper. And so it gave me the confidence to be able to have that, conversation with my clients to say, if I'm early, we've got the protection. And that's why, we advocate for clients right now to look at growth notes with 30, 40% downside protection, even though the market has already given up most of its gains this year and we were down 20% last year. Look at another 30 to 40%, because at the end of the day, volatility is so high right now, you're still getting a lot of upside. And so that protection, whether it's 25%, 30%, 40%, take advantage of the volatility because you're still getting a lot of upside in the market. And that way you never have to defend the question that your client's going to ask you saying, well, geez, I can't stomach any more losses in my portfolio. And so I'm going to sit on the sidelines. And this is something that Dr. Soss always taught me at Credit Suisse, which is the sequence of returns risk. And this is the definition of sequence of returns risk, is because in times like these, we should be investing, but we don't have the confidence to invest because we can't stomach any more losses. Thus, we sit in cash. Thus, we miss the rally. That happened all too often during the financial crisis. And I think that that's what's so powerful about these tools, is because you can have that protection so your client feels good. And more importantly, you can get the enhanced upside on the market, because let's not forget, if the S&P is down 20%, you need to be up 25% to get back up to par. So not up 20, you need to be up 25. And so the enhanced upside allows you to get back to even a little bit faster than just putting cash into SPY or a passive index fund.
Jason, let me, not to interrupt you there. Can you break that down for us? I've pulled up.
Please do, because I could go on forever once I get on my stump, as you know, David. And so exactly. So this is a perfect example of what we've been talking to clients about. Again, number one, it's about the empathy, making sure that we're talking to advisors of what we know is going on in the market, the stability of the financial system. And then more importantly, what are you going to do about it? Your clients just don't want to be consoled of saying it's okay. Clients want to know, hey, we all love a good sale, right? Yeah, this is why we shop around Thanksgiving and Christmas and all the big, Black Monday and Black Friday sales that go on, right? We all love a good discount. So what can we do to not only play defense in the portfolio with the protection on the downside, but what can I do to play offense? And this has been a very popular note, within our network over the last week. And this really talks to our hedged equity strategy that many of you probably have been hearing about, which the hedged equity strategy at the end of the day is layer structured notes linked to major indices right on top of your active managers. And by doing that, you get the protection in case the benchmark is down, and you get the enhanced upside in case your manager underperforms. It's a great two-way hedge within the portfolio. And so this goes directly to our hedged equity strategy, which you can learn all about on haloinvesting.com. But to this point, what is this note? It's a 3-year note. So as a refresher for those who aren't familiar with structured notes, every structured note has got 4 terms. If you can understand these 4 terms, you can understand any structured note out there. The first one is the maturity date. This one's a 3-year note. The second one, David, if you might flip that back for a second. The second one is what's it linked to? And this is the S&P 500. So it's linked to the performance of the S&P 500. The third variable is how much protection do I have? This has got 25% soft protection. So what does that mean? If the S&P is down 0 to 25% on the maturity date and on the maturity date only, you get your principal back. If the S&P is down 26, you're down 26. It's like a barrier. Once you puncture the barrier, you're fully exposed. Some people might ask, well, geez, I thought the point of the protection is to be protected in case, the market totally collapses. And absolutely, you can buy these types of structured notes with hard protection that act like a buffer. So if the market's down 26, you're only down 1, but you're not going to get as much upside. The thesis around using soft protection right now is we've already fallen 20% in the market. For this to breach, you'd have to be off around 45% off the highs. So that's a pretty big decline. And that's not a lot of the advisors' thesis out there, which is why they're using soft protection. And again, the protection only matters at maturity. It does not matter what happens prior to maturity. I always say, buy this note, go to sleep, and I'm going to knock on your bedroom door in 3 years and tell you to wake up and look at what the S&P has done. Okay. Now let's talk about the fun stuff, right? Which is the upside, because a lot of people are getting bullish in the market right now. This product gives you 125% of the upside of the S&P, subject to a max return of about 75%. So what does that mean? If the market is up 50%, right, you're going to be up around 60%, right? You're getting that 25% upside, you're at 65%. If the market is up 80%, sorry, you're only going to be up 74.5%, right? You are limited as the max return to that 74.5%. So you're going to multiply the return of the S&P 500 by 125% and do that all the way up until you hit 75%. That's how this note works. Why can this be attractive? Well, what I always look at is like, well, geez, it's got a cap of 75%, over a 3-year period, right? That's pretty good. That's over 20% per annum return if you cap out. So if I'm in front of clients and you're saying, well, geez, the downside of this is if the market really rips, we're going to be left with, just over a 20% annualized return. That's a pretty good conversation. Most clients want to make 5 to 7% on their portfolio. So that's a pretty good problem to have. Assuming that the market is not up 75% in 3 years, this is really nice because you're getting that enhanced upside I was talking about to make up for the losses in the portfolio faster than you would be if you were buying SPY, which is why I really like that enhanced upside.
Jason, can you comment about cash flow along the way? Who's getting the dividends on the S&P and et cetera? How does that work?
Great question, Dr. Soss. And so at the end of the day, this is a growth note. So these do not pay cash flow. So people often ask, well, geez, I'm getting 25% soft protection. I'm getting enhanced upside subject to a max return that's, almost 3 times the historical rate of the S&P 500. Sounds too good to be true. Well, you don't get the dividend, right? So you're sacrificing that, 1.86 or 2%, just to use round numbers, annualized dividend yield on the S&P 500. So over a period of 3 years, you're giving up 6%. Now, for me, that's okay because I have the protection and I'm getting the enhanced upside to make up for that dividend. Does that make sense?
Absolutely. And can you just say a quick word on the tax treatment of these? Because I suspect a lot of our audience has clients who are going to say it's tax season. My accountant is busy calling me about what's going on.
You read my mind. And so, Halo is a broker dealer and I'm a registered rep. And so I cannot give formal tax advice, but what I can tell you is I buy these personally. And what I have personally seen with my own taxes, and please consult your own tax advisor, is that on growth notes over 1 year, they're taxed at long-term capital gains. And so again, please consult your own tax advisor, and we don't give you tax advice. But from my personal experience, growth notes over 1 year are taxed at long-term capital gains. That's an important point because a lot of people will say, well, geez, why wouldn't I just buy options and reconstruct this thing with derivatives? And I'll give you 7 reasons if you want, but I'll give you the highlights, not to be too specific.
It's only an hour, Jason.
Yeah, exactly. How long do we have? But number one is that assuming that structured notes are long-term capital gains on the growth notes over 1 year, that is better taxation than options taxation, right? And so you can have some tax advantages. Again, consult your own tax advisor by buying the structured note versus the derivative strategy. Number 2, this has got 25% soft protection, right? It's a 3-year note. There's no exchange traded 3-year options, number one. And if you like that 25% soft protection, you're replicating that by buying 25% out of the money puts, and you're selling 25% out of the money binary puts. Most of us do not have access to be selling 25% out of the money binary puts. You have to work with a professional market maker, which most of us do not have. So it's very difficult to replicate the strategy. And last but not least, I always say, you know what's so beautiful about the iPhone or your Mac computer? I don't need to know how to assemble a computer to use a computer, right? And so option strategies can be very difficult because this is a 4-legged option strategy, which means you'd have 4 option legs within your portfolio, and you would need to have options paperwork at level 5, which most of us would not have, right? It's very complicated. Wouldn't we just rather buy the Mac? This is the Mac. It's one line item in your portfolio. You don't need options paperwork. And it's a lot easier to buy instead of having to match all the different option strategies. And last but not least, I said 3, I'm going to give you 4. So just, bear with me. I'm not going to give you all 7. But last but not least is that these are what's called European exercise options, which means the terms only matter at maturity. When you buy options in the listed space, they're American exercise. So you don't want to risk getting called out of one option and now you're backwards.
Yeah.
So that is the elegance of the structured note. Now, to your point, you talked about an income note. I would love quickly to talk about the income note that we are seeing a ton of demand in right now, which is this note. So getting back to that hedged equity strategy, people ask, well, where does this go in the portfolio in your hedged equity strategy? Well, if you look under the alternative investment section of our hedged equity strategy, you'll see a little sleeve of your Mad Money account, which I call it, Jim Cramer's Mad Money account. And I always have a 5% sleeve to Jason Barsema's Mad Money account in my own portfolio. And that goes under alts because at the end of the day, we're all suckers to buy something from the bottom and we all like a good stock pick. I look at that Mad Money account more than I look at the other 95% of my portfolio. And so that's where this would go. And what you're doing here is 2 things. Number one is you're capitalizing on volatility. Look at the yield on this product, 22.8% per annum. So unlike the growth product that gives you no yield, this income note only gives you yield. You don't get any of the upside of Schwab. You get that fixed return as David's circling right there. And so for round numbers, let's say it's an annualized yield of 20%. As long as Charles Schwab stock is not down 50% from when you bought it on the coupon payment date, which is quarterly, you're going to get your 5% coupon, 5% quarterly coupon. 5 times 4 is 20, right? So 20% annualized yield, it's a quarterly coupon, divide that by 4. That's how much you're going to get cash money in your account every single quarter. So as long as Charles Schwab is not down by 50% from when you bought it on the coupon payment date, which is quarterly, you're going to get your 5%. If it is, nothing happens to future coupons. You lose the coupon for that quarter, and that's just it. What I like about this is that Charles Schwab has gotten battered. And this is totally a throw the baby out with the bathwater trade because all banks have been smashed, even the majors, which are taking in all of these inflows. But Charles Schwab has got, $7.5 to $8 trillion of assets. And I'm not making a stock pick on Charles Schwab. I'm just saying of what our advisors are looking at. But these are some of the ideas that we've been showing our advisors because this is a very compelling way to take advantage of market volatility. And why that's important, right, is that the S&P note is giving you this really nice enhanced upside and a really nice max return, a lot larger than what that would typically give because volatility is high and interest rates are high right now. And that's why you want to be doing it. But that's the vitamins in your portfolio, right? It's like, okay, I get it. I'm going to buy that S&P note. I'm going to take advantage of the low levels. I'm going to put that right on top of my US large cap core manager because it's linked to the S&P 500. So you're going to hang that S&P note that we just showed you right over your US large cap core manager. It's called the layering strategy. Again, going back to the Halo hedged equity strategy. So if that's the vitamins, this is the rock and roll, And so what I love about this is that clients, again, don't want just to be called with, hey, everything's okay. We're all suckers for it. I'm a client too. We want to play offense and we want that juicy trade for us to be able to kind of hang our hat on. And this is really compelling. And we're not saying that this should be 100% of your portfolio. It goes in your Mad Money account. Consider this as a 1-2% sleeve of your allocation.
Dr. Soss, and I'll remind everybody, please keep your questions coming. Dr. Soss, a question we've got, can you comment on counterparty risk? Without getting into any specifics, naturally people are worried about it, the contagion effect. A lot of the buzzwords from the great financial crisis have been dug up again, and so they've been revived. Perhaps why is this time different? And what's your take on systematic risk or counterparty risk currently?
Sure. Well, let's go back to the last episode. It is arguable that the Fed's and the Treasury's decision and the Bank of England's decision not to put a floor under Lehman was what gave rise to the need to do precisely putting a floor under AIG a few days later. Because what Lehman revealed was the degree of interconnectivity in the financial system in a way that had not been fully or adequately appreciated before that day. And that's when counterparty risk became front and center, I think, from the point of view of the public authorities. And I think that the lesson that they have learned, and I think we saw this with the Fed and the FDIC and the Treasury's decision to put the absolute deposit assurance with respect to SVB and Signature, was precisely to say there will not be counterparty risk in this environment above and beyond what is absolutely normal. This is not a world where you take risk, without paying attention. You still need risk management. But the kind of chaotic increase in the perception of counterparty risk that occurred back then is something the authorities, I think, are really committed to avoid in this episode. It goes back a little bit to something I said earlier, which is I think the authorities are going to put an absolute floor, a no mas, never again, or at least not again soon, floor under some of these situations, on the view that once the crack in the sheetrock is revealed, you don't want it to split the walls apart. And I think that they are very mindful of that. I think all of their actions say that they're mindful of that. And on that score, I must say, I think that the powers that they have are on the whole pretty adequate. I personally think that the powers that they had pre-Dodd-Frank were also adequate, but weren't adequately employed or deployed. But I think it's fair to say that those powers were altered, but not really eliminated by Dodd-Frank, and they're in pretty good shape to put that floor under institutions. And we saw this, the Swiss National Bank saying, not only does Credit Suisse have, on its own volition, so to speak, plenty of support, but we'll give them more if they need it. With the authorities here in the States saying, yeah, we're not saying explicitly that every deposit in America is insured, but, we're sort of winking and nodding in that direction, particularly depending on the scale. Now, if there's some little community bank someplace that happens to have one of the first papers I ever wrote on the subject of financial fragility was actually about the failures of small banks. And it turns out community banks, at least when I did that research, came in two varieties. There was the one where the Main Street merchants were on the board of the bank, and they were the borrowers from the bank, and they were depositors in the bank, and those banks never failed. And then there were the community banks where there was somebody who thought that maybe we could make a little bit extra, and they would lend out of area, or they would lend outside the expertise of the local community's economy and so forth. And those banks were the most vulnerable. And I think in that same sense, you're not supposed to forego risk management in an environment of this sort. But I think that the kind of chaotic unraveling of risk, the moments when everything gets fully correlated and there's no place to hide and so forth and so on, is something the authorities will be very, very eager to avoid, and that I think they've got the powers with which to avoid it.
Absolutely.
Hope
And
that's responsive to the question.
I think that was very helpful. And it goes back to a conversation I was having with a client yesterday, about counterparty risk. And I said, look, there's the facts, whether it's about Credit Suisse's stability, the amount of capital that they have under their TLAC programs, and just their capital ratios in general, and many other of the European banks and the big, United States banks. So there's the facts, but then it's also about, the psychology, getting back to, our comment earlier, right? Is that your client and you as the advisor have to be comfortable. And if you're not comfortable holding the counterparty risk that you have, even if the bank, as we were alluding to, is very well stable or stabilized and capitalized and everything else, then perhaps you want to have that question or that conversation with the client to fight another day, right? You don't want your client to be scared and spooked on a daily basis, worrying about, that small exposure that you have in the portfolio. I dealt with this personally during the European debt crisis of 2011. There was a counterparty in my portfolio, which I was very confident in. One of my clients wasn't. The bank didn't fail, didn't even come close to failing. It was one of the world's largest banks, but my client was really spooked. And my job was to tell them, here are the facts about the banks, but I'm not going to go through another portfolio review with you if you're going to be this scared about the counterparty. It's not worth losing sleep about. So what did I do? I sold it at a loss. And the client was very receptive to that. I sold it at a loss. It was about 20 or 25 points from par. And the client said, what are we going to do? And I said, there's two things that we can do, because this is what I was proposing as the client was so spooked about it. I said, number one, on the positive side, is we're going to chalk up that loss, getting back to taxes, I guess, but we're going to chalk that loss up to future gains. So think of it as tax loss harvesting. There's a lot of gains in the portfolio. You're dealing with that right now with, within your own portfolios. We still have a lot of gains over the last 10 years. So it's okay if you're taking a loss and chalking that up to gains that you're ultimately going to pay in taxes within the portfolio. So that's number one. Number two, as I said, we're going to roll this into a major counterparty. It was a large American bank that they were very comfortable with. And we're going to roll that into a growth note because volatility was really high during the European debt crisis. And we got really nice upside. And I said that upside is going to help make up for that 20 to 25 point loss pretty quickly, because I'm pretty bullish on the markets. And what happened? Well, number one, the counterparty that we sold didn't fail. But even more importantly, number two is that the market ripped, and we made up for that 20 to 25 point loss, like I think within 9 or 10 months. And the client was ecstatic. And it was ecstatic not only because of the gain, but I took precautionary measures to make sure that the client felt good. And that's your job as the advisor. Your job is to help folks like me, like Dr. Soss, like David, and all of us sleep a little bit better at night. And that's where the power of structured notes come in. Yes, you're taking counterparty risk. Use counterparties that you feel comfortable with, like the big major banks in the United States, right? The too big to fail banks. If that's what you want to do, you have to feel comfortable about that, number one. But number two is the protection allows your client to feel comfortable in conversations like these that we're having right now of, is this 2008, 2009 2.0? It's our opinion that it's not, but we don't have a crystal ball. Nobody does. And that's the power of the protection that you can offer your clients to help protect against the unforeseen. That's the whole point. Now, it just turns out with volatility, you can also play a hell of an offense right now. And so that's kind of the fun part getting back to, is that these are the fun part of the client conversations, and say, yeah, we've got the protection, but boy, we've got this nice enhanced upside that's going to allow us to play offense.
Yeah, that is, by the way, another feature of these kinds of events, is that volatility tends to get higher and stay higher for a period of time, because nobody's entirely sure if the problem was put to bed or if there's a new problem lurking out there. And while you're not sure, volatility in financial life tends to go up. Is that good for the economy? Does it make a difference to the mortgage decisions or the or the auto buying decisions or consumer decisions, not so clear from past experience. Where it might make a difference is to business investment and to business hiring decisions.
Yeah.
And for that, typically a day or a week or a month even doesn't really create the shock. The shock is if that persists for long enough that people take a completely different view of what the future might look like.
And that's so important. Like, look at what the Swiss National Bank did last night. Again, we're not here to give counterparty advice, and you have to, do your own homework, and it's important that you feel comfortable. Credit Suisse is one of the best capitalized institutions in the world. That's just the facts. And of course, if you'd like, we've got all the data, we've got all the things that Credit Suisse have put out. We also just hosted, some of the senior team of the Credit Suisse Structured Note Group for our clients to, just get some feedback and make them feel comfortable about, where we are, and advisors can use their own decisions. But the SMB came out and said, great, you're very well capitalized, but here's another $50 billion. The Fed just come out and said, great, you're worried about deposits? Wink, wink, nudge, nudge, nudge. We're going to make sure that we stand behind all depositors. And that's the importance of what central banks are doing, but it doesn't just solve everything overnight. The market is going to want to see, what does this do? So if you're wondering, why is there still volatility in the market? Why is there still volatility in some of these bank names? It doesn't just happen overnight. We're all investors, right? We're going to say, hey, are you true to your word? Are you really going to backstop? And in our opinion, right, in my opinion, just my own personal opinion, I feel very comfortable about the stability of the financial system.
Well, and just to elaborate just a tiny bit on that, if I may, it's not necessarily the people who are worried about the next bank. Well, then maybe that's what they're worried about, but typically risk happens from the thing you're not thinking about or not watching. And it's these peculiar linkages that you didn't think about, that you didn't know about, that suddenly manifest themselves. So I said earlier that, the fact that so many financial portfolios have a big block of underwater, mark-to-market underwater, not credit issues, interest rate issues of assets, means that it might not be a bank. You just don't know. It might be that some insurance company or who knows whom turns up, to be, so to speak, in the spotlight. And that's another source of this volatility, is the risks that you might be lurking, but you don't know what they are. This goes back to Donald Rumsfeld's famous things we don't know, we don't know.
Yeah.
And sometimes those loom large, and that's a matter of human psychology, I suppose. But again, anytime there's a disruption of any sort, not unreasonable to think that it might be increasing the odds of one of those out of left field events. So volatility tends to remain up, for a period of, for some stretch of time, until people forget that there was a problem in the first place.
Absolutely. David, I know we've only got 5 or so minutes left. Were there any other questions from the field?
Sure. So here's a question for you, Jason. Obviously, Halo, we do a fair amount of custom notes. Can you comment on principal protected notes and market link CDs and other more conservative plays available?
It's a great question, because it's one of the things I've had to eat crow on, as they say, as I've never been a big believer of principal protected notes. And the reason why, right, is that, if you think the S&P is going to zero, then you probably shouldn't hold equities, right? You're just paying for insurance that you don't need. However, in this interest rate environment, in this volatility environment that we're in, terms on principal protected notes and market link CDs are looking really good. And so going back to the sequence of returns risk and our whole point about providing a more efficient and sufficient savings product, I actually have changed my tune on that, candidly. And I think that principal protected notes may make a lot of sense in this market, because now that interest rates are higher and volatility is higher, the terms on principal protected notes look quite compelling to very vanilla underlyings like the S&P 500. A few years ago, the math didn't make sense because interest rates were so low. And so you had to get kind of funky in regards to the underlying or what the structured note was linked to. And I didn't really like that, candidly. But now that interest rates are a lot higher, I encourage people to take a hard look at PPNs, principal protected notes or market link CDs, because it might give their client the confidence to be able to get invested if they are indeed extremely spooked. And that FDIC wrapper that you've got underneath the market link CD would only exacerbate the confidence that someone would have to get invested. And by that, then I so totally support the product. It still goes in your equity bucket though. And so, that's the thing, is like, your bonds are your bonds, whether it pays income or not. If you're taking equity risk, it's equities. Don't touch my sleep at night money. So if my advisors out there are listening, don't touch my sleep at night money. My bonds are my bonds. Don't touch it. Structured notes are your equities.
Jason, a question about volatility. Can you break down how does volatility impact pricing and structured note structuring?
Yeah, a great question. And so, structured notes are really two components, right? So I always say structured notes are like a candy wrapper. And inside the candy wrapper, there's two assets. There's a zero coupon bond, and then there's a derivative, right? And so when you look at the structured note itself, about 80 to 85%, depending on the maturity, is the zero coupon bond. The rest of it is the derivative. So a lot of people think that, I'm only going to buy structured notes when vol is really high. It's actually not the right way to think about it, because number one, you don't drive a car, you don't have insurance on your car only when you're driving fast, right? Like, you don't know when you're going to get in a wreck. You can get in a wreck when you're driving 20 miles an hour, right? Don't they say 70 or 80% of accidents happen within a few blocks of your house? And so you always want to have that protection in your portfolio, whether interest rates are low, whether interest rates are high. And again, it sounds like I'm talking my book, but I've been doing this for 15 years. I put my money where my mouth is, because I always want that certainty, at least from myself, that I've got the protection in case, as Dr. Soss just said, it's the unknown unknowns, right? I don't know where else a boogeyman is. And that's why I've got protection. Now, so interest rates, because the zero coupon bond is 85% or so of the structured note, that actually impacts the pricing the most of a structured note. So now is actually a really good time to buy structured notes because interest rates are higher. The cherry on top is vol, right? So obviously when vol goes up, you're getting really nice coupons or participation rates, depending on the types of structures. So when you look at hard protection right now, everyone's buying puts out in the market. Those terms aren't as attractive as soft protection. They're still very attractive because vol is up and interest rates are up. But when you compare hard versus soft, given where volatility is, soft protection looks really compelling. When you're looking at how an income note is constructed, it's selling puts and selling binary puts. That's how they're generating the income, right? And so from that perspective, you're seeing those yields on a Charles Schwab note at 22%. Like I just showed you. Typically, that would be probably like 8 or 7, if that. So that's kind of the rock and roll I was talking about, is going to a client and say, yeah, and you can use the Halo platform for this of, Dr. Soss, this note normally yields 8. Do you think Schwab is going to go under? No, probably not. Okay, cool. Do you think it's going to be down 50%? No, probably not, because it's already been taken out to the woodshed over the last 2 weeks. Great. This is yielding 22% per annum. That gets our eyebrows up, and it gets our eyebrows up for our clients to be able to listen to to take their vitamins, which is the S&P, which is the Eurostoxx 50 notes, the index notes that you should be layering on your portfolio and the majority of your portfolio.
Okay, last question. I'll pose it to both of you guys. I know you guys are busy. Jason, I know you got client calls coming up. Dr. Soss, your cute dog looks like he's ready to go outside. He made it up there. Although I think he went to take a nap. Maybe he doesn't like economics.
I love it.
I can't blame him. So it's in the fog of war in these instances, shocks to the system, however we want to call it, where dislocations happen. And that's where the magic of the structured note can come into play, is that you can take advantage of this structural alpha, right? Without getting into Bill Gross's, the Bond King's thesis on structural alpha. The note's efficiency can tap into or take advantage of some of these dislocations. My question to both of you, why is this time different for the structured product, structured note versus the market today versus say 2008? What is different? What has changed in your opinion? And approximately 15 years or so?
I'm happy to take that question first. Obviously during the financial crisis, it was a systemic, problem. At first, it was a confidence problem that turned into a liquidity and a solvency problem very, very quickly, which is why you had all the shotgun weddings that you had during 2008 and 2009. It is my opinion that we are not in that position today. Obviously, look at where the regional banks have gone, and they've gone to, the assets have gone to the major banks, and the too big to fail have just gotten bigger. So I think that there's a lot more stability within the system. Obviously, Lehman collapsed. I think looking back on that, perhaps a different decision would have been made. And I think that we've all taken our medicine and understood the consequences of an institution like Lehman collapsing. And so that is why it's a little bit different. Halo works with major issuers to give you that confidence of the counterparty risk that you have. And number two, it's a different interest rate environment. And so, terms on structured notes are looking really, really good. Now, let's not kid ourselves. Volatility is high, but the VIX is at around 30 last time I checked. When we were cutting our teeth at the crisis, the VIX was at 85, 90, and we were asking, can the VIX actually go above 100? That was a lot of the questions that we were asking. And so this time, this is not the financial crisis. We need to have rational expectations and rational thoughts about the capital and the backstop that we have from the Federal Reserve and the government. We need to be rational with our decisions. And that's why I think, and in my opinion, this can be a very compelling time to buy and utilize structured notes, because we don't know when the bottom is, but when that bottom hits, man, we are going to freaking rip. And that is the point about having the protection for early and the enhanced upside. Because when we're ripped, when we do rip, you are going to be able to capitalize on that through the enhanced upside and the nice juicy coupons that you're getting from like those Schwab notes. That basically you're getting paid to wait. So that's why this is a little bit different.
Bring us home, Dr. Soss.
Well, I'm tempted to think that being an economist, it's my job to end on a slightly downbeat note. So I will.
The dismal silence.
Here's what it is. Here's what it is. And I think it's interesting. Jason, I think, quite properly pointed out the shotgun marriages that was part of the attempt to put stability into the system last time. And I'm not sure that that was the thing that created stability. It strikes me that the thing that ultimately created the stability was the public authorities putting public guarantees under certain critical institutions, so they didn't need to close the doors, so to speak. The good news in this episode is I think they've gotten there much sooner, and I think arguably pretty effectively. The downside, to the degree there is any, is it's hard to do shotgun marriages with the biggest banks, because the biggest banks are limited in their ability to get even bigger in a non-organic way. So, as Jason said, you got to be comfortable. You got to do your homework. There's no substitute for it. But if you've got an instrument that gives you some comfort and you've done the homework, that's the job. I'll stop there.
All right. Well, thank you both, gentlemen, for your time today. And thank you for our audience participation. If we didn't get to your question, I promise our team will follow up with you. You're encouraged to check out haloinvesting.com. We'll get you the replay of the webinar here. And the phone is always open. Let us know if you got any other questions beyond what was discussed here. We look forward to speaking with you soon.
And I'd just like to say we appreciate everyone's partnership, and David's David's accurate. If you need anything at all, don't hesitate to contact our team, whether it's a trade idea or just comfort. And don't hesitate to contact me directly. This is my job, and this is what I love to do. So please don't hesitate to reach out to me directly.
All right. Thanks, gentlemen. We'll log off from here.
Thank you all.
Thank you.
Dr. Soss.
Thanks, Dr. Soss.
Thank you all.